I'm going to explain Ind AS 20. What is Ind AS 20 all about? Ind AS 20 is accounting treatment for government grants. So what's the objective of this standard? The standard deals with accounting treatment of government grants and its disclosure requirements for the preparation of financial statements to make it comparable. So let's move on to the next topic. Next topic is scope of this accounting standard. This accounting standard is not applicable to the special problems arising from the government grants, like effect of price changes and government assistance in the form of other than government grants and government participation in the entity. So let's talk about definition of government grant. So what does government include? In this standard, government includes local government, national government, international government and similar bodies of same type. Definition. Government grant is assistance provided by the government in the form of cash or kind for the past or future compliance of conditions. So let's move on to the next thing. Next thing is recognition criteria for disclosing government grants in the financial statements. So the first condition is the entity should have reasonable assurance in the fulfillment of all the conditions for recognizing government grant in the financial statements. And the second condition is there must be no uncertainty in the ultimate collection of government grants. Provided that both the conditions are satisfied, an entity can go forward in recording the government grants in the financial statements. So now let's discuss about the accounting treatment. Accounting treatment of government grants can be classified under two approaches. So the first approach is capital approach and the next one is income approach. So in capital approach, we deal with when the entity receives any assistance in the form of fixed assets or in nature of capital. And in income approach is applicable when an entity receives government assistance for the expenditure incurred. So now let's deal with accounting treatment under capital approach. So capital approach basically deals with government assistance provided to the entity in relating to the fixed assets of the entity. So suppose if you take an entity has a fixed asset called furniture amounting to rupees 5 lakhs and the entity has got government assistance in the form of government grant. So the journal entry the entity should pass as cash or bank account debtor to deferred government grant account. So the amount will be recognized at fair value of the asset in case of Ind AS 20. So this deferred government grant account should be amortized over the period of the asset. So the period of the asset is assumed usually 10 years or 15 years. It depends according to the depreciation schedule followed by the entity. So now let's take a case of an example. So let's discuss an example under capital approach. So on the capital approach, say if an entity has to purchase a furniture amounting rupees 5 lakh, and entity has fulfilled all the conditions to get government assistance and the government has provided assistance in the form of government grant, the journal entry the entity will pass for the cash amount received from the government is cash or bank account debit 5 lakh to deferred government grant account 5 lakh. Say for furniture amounting rupees 5 lakh, and this 5 lakh should be presented in the financial statements at the fair value at the end of each year. So this deferred government grant account will be amortized over the life of our asset. So for example, for furniture, let's assume useful life is 10 years and the entity is following SLM method. SLM method is nothing but straight line depreciation method. So on the straight line depreciation method, the depreciation amount will be equal to original cost of the asset divided by useful life of the asset. So in this case, the depreciation amount is 5 lakh rupees divided by 10 years, that is 50,000 rupees per year. So at the end of each year, the entity will pass journal entry for depreciation, that is depreciation account debit 50,000 to furniture account 50,000, and this depreciation account will be reflected in the P&L account as P&L account debit 50,000 and to depreciation account 50,000. So now useful life is 10 years, right? So this deferred government grant account will be amortized in 10 years. So as entity is following SLM method, so for the amortization of deferred government grant also we follow the same method, that is 5 lakh rupees divided by 10 years, that is amortization cost will come up to 50,000 per annum. So amortization of deferred government account journal entry will be as follows: deferred government grant account debit 50,000 to profit and loss account 50,000 at the end of each year. So this is the accounting treatment in case of capital approach. I hope you all understood this. So now let's deal with income approach. Income approach of accounting treatment of government grants is generally applicable for the expenses incurred by the entity, for which entity raises government assistance provided all the conditions are fulfilled for recognizing government grants in the financial statements. So let's take an example. If an entity has estimated labor costs to be incurred in the following 3 years as 1.3 lakh and 1.1 lakh and 1.2 lakh, which sums up to 3.6 lakhs, and for which entity has raised a request for 6 lakh, and suppose entity has got a government grant in form of assistance. So the journal entry to be passed will be cash or bank account debit 6 lakh to deferred income account 6 lakh. So here we are following deferred income approach for accounting treatment of government grants under income approach, which we used to follow similar under capital approach, but capital approach was generally preferable for treatment of capital assets, that is fixed assets. Here we are dealing with treatment of expenses. So if entity has got 6 lakh rupees and the journal entry is to be passed as cash or bank account debit to deferred income account, so this deferred income account will be amortized over the period of expenses to be incurred. So here the expenses to be incurred in the 3 years is 3.6 lakh in total. So the government grant to be amortized or recognized in each year will be as follows. For year 1, it will be 6 lakh is the total government grant received. So 6 lakh multiplied by 1.3 lakh divided by 3.6 lakh. 3.6 lakh is total expenses and 1.3 lakh is the expenses to be incurred in the year 1. So the amount of government grant to be recognized as income in year 1 will be 2,16,667 rupees, and the same way it will be for year 2 and year 3, and the journal entry to be passed at the end of each year for recognizing government grant income in the profit and loss account will be deferred income account debit to government grant income account, and this government grant income account will be transferred to profit and loss account, that is government grant income account debit to profit and loss account. So this is all about income approach. So now let's move on to the next topic, that is refund of government grants. An entity should refund a government grant it received if it does not fulfill any of the conditions. So the journal entry to be recorded under both the approaches, that is capital approach and income approaches. Deferred government grant account debit, that is balance appearing in the financial statements. Profit and loss account debit to cash or bank account. To cash or bank account is the amount refunded to the government. And profit and loss account debit will reflect balancing figure. And if deferred government grant account balance is 0, so the entire amount will be recorded as profit and loss account debit to cash and bank account. So now let's move on to the next topic, that is special circumstances. Under special circumstances, any government assistance received to the entity should recognize it as extraordinary items in the financial statements. So what comes under special circumstances? If only one entity in the entire industry receives immediate financial support from the government, it should recognize that extraordinary items in the financial statements. Or if the receipt pertains to any previous year expenses or losses, it should recognize it as extraordinary items in the financial statement. So these two items comes under special circumstances. So the next topic is disclosure requirements. Disclosure requirements deals with what are we supposed to disclose in the financial statements for accounting for government grants. So we are supposed to disclose the policies adopted for presentation of government grants in the financial statements and measurement and amount and nature and extent of government grants disclosed in the financial statements. So with this, we come to the end of the topic. Signing off, Devaprasad S.